Hello, everyone. Welcome to today's session. Uh, if you have any questions that you'd like me to go over, feel free to type those into the dashboard, the webinar dashboard. There's an area for questions. Feel free to type any questions that you may have that you may want to have covered. Also, if you can hear me and see my screen, just let me know. I think that we are good to go. So I will jump right into it here. I'm going to start out with the buy-sell ratio as we talk about current market conditions. We've seen the width of the overall buy-sell ratio as that market starts to top out, starting to come back together again pretty aggressively in the last few days, minus yesterday's move. And we had been talking about these over the week, last week, and this is a pretty common occurrence. Once you see that buy-sell ratio start to settle in these upper ranges for that length of time, you can see back here last year or the beginning of last year, some of these bullish trends. This has been a really nice one and really intense as far as the overall uptrend and the length of time. Really now going on 2 months now for this uptrend. Those are just not sustainable. The long-term uptrend certainly can be sustainable, but the shorter-term trends have they just ebb and flow. They have these cycles of uptrends and then retracing and profit taking and then creating a new base, creating a new demand area for more upside. So markets are doing that currently. We haven't seen a bearish crossover yet. And one of the things that's interesting too is you'll notice, the depth of this buy, the buy line. This signal does not include holds, and so when a bunch of stocks go from buy to hold, it doesn't show up in the sells yet. So sometimes in a transition, you won't get a big spike in the selling yet because a lot of these stocks have just moved from buy back to hold. And that's what's happened here. We'll take a look at a couple of examples. And that's why in this long-term direction alerts, we're still sitting at mildly bullish. It moved from bullish to mildly bearish, back to mildly bullish. And part of that is because we're still in this overall long-term uptrend, but we're topping out, or at least we're at a topping location. This is the S&P 500. This was our low. We had this real strong rally to the upside, and now we've just been consolidating a lot of that move. And we still have sentiment. We have momentum that's moving back up into this upper range. It's still kind of caught right here in the middle. But we do have breadth and sentiment, which are still quite bullish to the extreme area. Now, that doesn't necessarily mean that they can't maintain that extreme area. And if you think about what's happening, the breadth of the market, which is currently 90, that means that 90% of stocks in our database are in uptrends. And so that has a pretty strong effect on buying the dips. Okay, so when we have a lot of strong stocks in uptrends and we get a pullback, we can now kind of set our mentality for that buy the dip. And that's part of what this first paragraph is saying. We're mildly bullish. This means that investors should consider trading with a neutral to a bullish bias going long. So we're still in that bias. We haven't retraced and moved low enough or far enough back on S&P 500 for it really to be considered a bearish trend. In fact, it was getting there, and the support ranges, now we actually had these support areas which held up, and then we finally got that move back up to the upside here as well. Let me change that color here so we can see just some of the price activity. I'll get rid of the volume as well. So we're seeing S&P 500, good solid move yesterday. Today it gapped lower and is now kind of fading towards the upside. And that's good. Again, bullish sentiment, buying the dips, anything that's pulling back, we're still seeing that. So even this retracement that we saw in S&P 500 was relatively mild, even though in that buy-sell ratio we saw a pretty decent move back down. That's pretty common. And again, that's one of the reasons why we want to use multiple definitions of what a market actually is, because S&P 500, SPY, works well as a market because there's 500 stocks. The only problem is it's become pretty heavily weighted towards a handful of stocks, 10 stocks that can move the S&P 500, like Apple and Tesla and Google and Microsoft and Meta. Those stocks really control the narrative currently. But so it might be skewed slightly towards those stocks versus looking at something like the buy sell ratio, which is also really a market in and of itself because it's an entire database of stocks, and that entire database is doing something versus just the S&P 500 and the 10 stocks that are controlling the S&P 500. So it's those are the mainstays of indices, S&P 500 and Dow, NASDAQ 100, but it's also helpful to look at some additional perspectives when it comes to that. And buy sell ratio is a great one. Primarily in number one, do we have a buy sell ratio of 1 or higher? I don't like that size either. Keep fiddling with this size, but this is buy sell ratio. Let me mouse over that. We're at 1.63, so we're positive still, and obviously if it's above, it's going to be 1 if the green line is above the red line. If the red line crosses over, then that buy sell ratio is less than 1, kind of like it was during the bulk of this move right here. So the bulk of that move was a -1. So we're right at that phase. We're seeing a retracement. We knew we had a nice uptrend. We're pulling back. So is it going to establish a new base right here and start to move back up again? Or are we going to get a little bit deeper retracement? That's a question that obviously the market is going to have to answer as things unfold. So when we're trading and we're focused on what is the market telling us, essentially the value of what the market is telling us is what should our bias be? What direction should we be doing, and what should we be doing with our portfolio in terms of allocation? Should we be raising cash levels? Should we be taking profits? Should we be buying more? That's really the value of what the market conditions are telling us. Are we in a bear market? Are we in a bull market? If we're just in a flat out bear market, maybe we don't do anything. Maybe we just sit on our hands, or we're in bearish, inverse ETFs to just to preserve capital. Lots of different things that we can do strategically once we know what the market conditions are doing. From there, because each market condition, stocks behave slightly differently. Obviously, in a downtrend, you're getting a lot of big institutional money and a lot of algorithms that are just designed to do things to the downside. When we're in uptrends, all of those institutions and all of their algorithms, they're designed to do things to the upside as well. So we want to focus on what's the momentum, what's the path of least resistance, and be on that side of the overall market as often as we can and as much as we can. Okay, so that's the real value of this. The other pieces of this pie, bond yield curve. I include the bond yield curve on here because it really is, historically, it's been a great indicator for looking at economic conditions, not necessarily stock market conditions, but economic conditions when we're talking about interest rates. So if you're not familiar with what a bond yield curve is, bonds have different durations. From the shorter duration, meaning when it's due. I'm going to tie up my money for a certain length of time, and at the end of that time frame, I'm going to get a certain payout, right? The capital that I invested and the interest payments as well. Depending on the length of time, you're going to get different interest rates. Well, the issue right now is that if I'm tying up my money in a long-term bond for 30 years, my interest rate is, let me mouse over this here, my interest rate is 4.2%. But the market is also paying for me to tie up my money for 3 months, 5.47. So why on earth would I tie up my money for 30 years at 4% if I can get 5% by tying it up for 3 months and then renewing that? If it comes, think of a CD, like a certificate of deposit at the bank. They typically have 6 months and 1 year and 5 year, something like that. That's kind of like a bond where the interest rates, you're locking it up for certain amounts of time. And the longer you lock that up, typically you get paid more money to lock it up. In this case, that's in an inverted yield curve. Inverted means that the direction is this way. It should be this way. Okay, a normal healthy bond yield curve looks like this. Okay, let me go back here to right, let's say by around here. Okay, early 2008 and 9, when we had all the subprime mess. Well, look what the yield curve was doing then. Almost inverted, not quite yet. And typically, when you're hearing that, they're usually inverting at the 10 and the 2 year, meaning that the 2 year is higher than the 10 year. That's typically what an inverted bond yield curve is looking at. But we've got a little more data that we can look at here as well. So a normal yield curve looks like this, and that is shorter term duration and longer term duration are paying based on the amount of time that you're locking that up. Well, longer term yield curves, an inverted yield curve, and this is a bad one right now still. So, and one of the reasons, the rationale behind this is the Federal Reserve is tightening and loosening the money supply by playing with these interest rates. They don't want as much money in the system, because what happens when there's a lot of money in the system is that money chases goods and services, and it creates inflation. So if there's a lot of money chasing fewer and fewer goods and services, the price of those goods and services is going to go up. If there's more demand for, if there's less demand for the yields or the goods and services, and there's less money, I should say the opposite of that. If there's more demand and less money, then you're going to get a different scenario than if there's a lot of money just chasing those goods and services. Okay, so both things are kind of happening where you're getting less money chasing less goods as well. That's the whole point. The Fed's trying to stamp down inflation. So historically, every time, not every time, but the vast majority of time, we get an inverted yield curve, we get a recession as well, an economic recession. So this is just kind of keeping an eyeball on it. It's not necessarily predicting anything, but it is, I think it's valuable to say, what's the economy doing? At least what's the Federal Reserve, what's their perspective of the economy? And there's still an issue with inflation. There's still an issue with interest rates, and this bond yield curve is still not in a healthy state. So what does that mean? Does that mean we move everything to cash? Possibly. If your time horizon is short and you're needing money, and you're able to get a 5% interest rate annually in cash in your checking or savings account, then that makes a lot of sense. So there is rationale in having cash, even though inflation, the theoretical discussion is, well, yes, cash, you're ultimately losing money because you're losing your purchasing power. If you have cash at 5% and inflation is at 5%, I'm really not growing my money. But nobody thinks like that. At least most people don't think like that, unless they're really longer term investors and they have larger capital that they're dealing with. The vast majority of people are just like, man, I don't want to take any risk. I don't want to lose anything. I need this money. And so but I want it to be able to earn some kind of interest rate. And so you have those different perspectives happening. So that's the bond yield curve. Spent more time there than I really wanted to, but that's why it's there, is to give you just a quick insight of what is what's happening at the bond yield curve. You can go out and Google bond yield curve analysis, and you're going to get 1,000 different perspectives, and all of them would be interesting to understand as well. The sentiment indicator is looking for extremes. Okay, we want to see if we're anywhere near the red or the green locations, and we're also getting an extended buy-sell ratio. We're probably going to slow down. Okay, we're probably towards the end of the trend. And December, the first move higher, the first spike here was November. Okay, so if we go back here and we look at the markets, and we look at that first spike in November, it was right around here. It happened pretty quick. So it was this one. And then we've just kind of been continuing to trend higher. We get this second peak, and then ultimately that was the peak that ended up moving things back down, and that was right around actually here. So really from here, the sentiment line has just been continually moving back down again. Oftentimes we also see this 50% area hold support and resistance. So if we retrace a little bit more on the markets and we maybe find some support here, we could see an uptrend in sentiment as well. So just a quick analysis and what these are for. The market trend analysis is simply for where is the market in a long-term bull market? Is it in a bearish state in that bull market? or a bullish state in that bull or bear market. And how do I want to allocate my capital accordingly to where market conditions may be? We know that if markets go straight up and we're at the top end of a range, and we're even from this last range right here, it's lasted about almost a month now, and we really haven't done anything. That's going to be a common scenario when we have wide buy sell ratio, we have high sentiment towards the upper end of the range. It's going to consolidate. In this case, we now have an additional indicator that we can say, well, what's the trend? Well, we want to connect to this upper trend and this lower trend, and we want to see that this pattern, this sideways consolidation, happens above this 236 line. And if that continues to happen, and then ultimately it takes a while and then it just works its way higher, that's great. That's fine. That's normal. And the fact that we're still above that line and finding some support, we did find some support, that's still quite bullish. So we'll see if this holds up. Sometimes at these market trend tops, you'll see a spike, and then you immediately see a bearish bar or two come back down again. Not always, but sometimes that does happen. And at this point, we're still seeing some bullishness happening, and that's the motive right now. That's the trend. That's the thesis. What in terms of what should I be doing? I want to be looking for directional things still moving to the upside, but because we're at the upper end of the trend, I want to do it maybe with smaller position sizes or less capital, or not as often. Okay? It's a management style for the stocks or ETFs that I'm picking. Okay, from there we can go into, well, what are my leading sectors? My leading sectors, we know that ETFs are a great tool to be able to just see kind of groups of activity. So here we have with our sentiment, with our sector indicator, we're looking for what is the bulk of this doing? And those of you that have been watching these updates now for a length of time, you've seen this. These will change. A month or so ago, all of these were green. Now we're starting to see a few hiccups across the board. This is also a little bit of a story. It's telling a story that we're getting some pausing here across multiple industries, where there's a handful that are working, but look what they are: healthcare, utilities, financial, consumer goods. Those are all defensive sectors. Defensive, not defense, but defensive, meaning for bearish market conditions or recessions, oftentimes healthcare, utilities, not always financial, but consumer goods, those three things, those are things that people still have to have. You still got to buy stuff, still got to buy toilet paper and soap. We still have to pay our utilities for heat and gas, and we still have to have healthcare. So those three sectors typically continue to do well when there's an anticipation of something economic that may be slowing down. Plus, we had a massive run in technology. We had a massive run in real estate. We had a huge run in industrials. Energy's just kind of been floundering right here, which is fine. And so these are, it's not surprising to see these cooling off and these taking off right here at these levels. So we are seeing a little bit of sector rotation at this market top, and that is also pretty normal as well. So we want to be able to participate in that rotation. What's the best way to do that? Well, one of the ways to do that is to look at your sector scan group, see which ones are still leading, and then focusing on the upper, the top stocks in those groups. Let's look at construction. We've seen a pretty big sell-off in construction because we had a big run-up. I'm going to come back here. And we had a huge number, almost all of these 80 stocks were up in this range. So now we've seen the buy-sell ratio across the board start to cool off. We're seeing transportation that is still quite hot here at 4.52, utilities at 2.53. So we're seeing buy-sell ratios, even though you've got a leading rank. The leading rank, remember what the rank is. The rank is the average of all of the stocks in that group. So if I have an average rank of 70, that means the average rank of all the stocks combined is 70. So that's the leading rank. But it may not have the highest buy-sell ratio. It still does. It's almost 2. This one's 2.53. So you just have a few more stocks in this uptrend. So those could be still a couple of places to consider. Why is construction still working? Well, construction is still working because the market now anticipates interest rates to be coming back down. Well, what benefits the biggest by, or what is forced the most to use interest rates, and that's construction. They've got to lend, they got to borrow money to do the vast majority of the construction, whether that's commercial, whether that's residential. They borrow money to do that, and in borrowing money, if the least expensive money, if you can borrow money for cheaper, I should say, meaning interest rates are lower, then you're able to get more bang for your buck. And but these companies still have to borrow anyway if they're growing, and so they continue to do well unless you really get a slowdown and a big recession where nobody's doing anything, everybody's just sitting tight. That typically is not the case with construction, particularly commercial construction and even residential construction. We're just seeing such a huge population boom that there just has to be building taking place, and it's part of again the theory behind that. Same with utilities. You're seeing some nice utility moves. I'm going to click on this one again, see if we can pull back in. So we are seeing Hovanian has been really the big, that thing has just been a beast right here. And so you see this big run up, and it's just consolidating. It looks kind of similar to the market, big run up and then consolidation, but this is all happening inside of that upper momentum zone. We've now pulled back to a sustainable location. Remember, when I talk about these rallies and sustainability of the trend, well, this obviously is not sustainable. Okay, and this would have been, the momentum would have been all the way up to this range. In fact, we can look at that over here. When I mouse over this chart, it's going to show me what the momentum is. So 215 was the spike right there, 200, 224, 281. So 311, 283. So during this entire rally, this arrow was stuck all the way over here. Okay, that's fine. Uptrends like that are powerful. They can happen very fast. Now, what's happened though, is it has come off this extreme and moved back into a sustainable location, meaning that now this line can it could build some momentum again. It could spike. It could go up, and this line could become extreme again, and then it consolidates. And this goes from extreme back into the buy zone. So that's when we're talking about the buy zone. What that is it's just a non-extreme location in a current uptrend. And so really anything inside of this area, it's still momentum driven, but it creates an area where I can just quickly eyeball and say, could I get a new uptrend now because of this signal? Well, I'm in the momentum zone. I've bounced twice. That means we've got some support there. That means there's some demand, and we're relatively early in this trend. Could we hit resistance and trade back again? Absolutely, we sure could. But we get higher and higher probabilities when we get a little bit more refined in our entry process, so that we are doing the same thing each time. And that's really the value of the entire TradersPro method, is creating consistency so that you're doing the same thing each time. And then you don't have to think as much. Then you don't have to worry as much. You don't have to wonder as much. You kind of take your head out of the game a little bit more and just focus on what's working and focus on the trends that are happening. I can talk until I'm blue in the face about why I think interest rates are this, or why home building is doing this or that, and try and explain what is happening. But honestly, it doesn't really matter. It is happening, and that's the more important piece, is what is happening and what trends are happening. And a lot of times you can kind of backfill the theory of, well, this is moving just like I did. This is moving because interest rates are perceived to be coming back down again. These guys still got to build homes, and therefore they may be more and more profitable. Is that going to be the case? Who knows? The market, or the vast majority of market participants like this stock and like this idea for whatever reason. So we don't have to be brilliant on why we think it's doing this or that. We just have to be a part of the trend. And when it stops working, then we move out of it. We move into something else that is working. Another really quick way to be able to do that is the muscle stocks scans. Taking one, the new buys, for example. If we're focused on a stock that's moving, here's a great example. This stock, SLNO, medical biotech drug stock, big gap higher, retraced, continue to move higher. I bought it in the new buy portfolio right here. So, and it's up we'll take a quick look, but I think 50, 60% somewhere from there. And now it's consolidated sideways, moving sideways with that after that big spike. It has to pause. It has to take a breather. Think of a runner. Okay, I've mentioned this analogy before. A runner, primarily a sprinter, when they sprint, they can only sprint for so long before they have to take a rest. Okay, and those rests are when a stock sprints, it has to rest, and then it sprints, and then it has to rest. So is the next sprint about to begin? Potentially. It's in a location where it certainly could happen from there. But so these long rests are normal and good, but we have to analyze those still based on trend levels. We don't want to have a stock that we think is working and then all of a sudden it stops working. And by not working, I mean moving down in price, dropping, okay, going lower. Then we want to be able to get rid of it. As an example, let's see, we've got a couple new ones in here, and there's one, I think it was this one, AVAH. So this one is one that we had a new buy signal right here. Okay, so that's the new buy, and then this is all the action since then. Okay, it's either going to move up, it's going to move sideways, or it's going to move down. There's nothing else that it can do from here. So that makes it pretty easy for us to decide, well, at what point do we not want to participate in this stock? Well, at some point, if it continues to start dropping, then we need to preserve the capital that we've invested in this stock and sell it. Cut the losses, sell it, and move on to something else. Okay, we don't have to beat ourselves up and say, man, I'm such an idiot. I shouldn't have bought that thing. It's just doing what it does. We have zero control over that. And some of them are going to work out amazing. Some of them are not. Some of them are going to be average. Some of them are going to get stopped out. It's just kind of the nature of stock trading and investing as well. We just want to have a systematic way to do that. So in this case, I'm watching this because my stop loss, I think my stop loss on this is sitting right at $2. Okay, so $2 is the stop, and so that's a ways away. I've got a pretty wide stop on this because I wanted to go below this. So I'm okay with a lot of the fluctuation right here. And that's an important thing to know at what point you're okay still. If I've set up the trade correctly, then I know that I'm okay because I set my stop in advance. And that means that I set my capital size in advance. And that means that I'm following my trading plan and therefore I'm okay. Okay, so if you get a scenario where you buy a stock and it's like, oh my gosh, I'm underwater, I'm losing. Oh, what should I do? Well, what is your plan for what you're doing? Here in this case, my portfolio, I'm down 6% on this, and another 50% is probably another 6%. So maybe 10 or 12% at risk on this trade. Okay, I don't think I have, let's see, AVA, if we can pull this in here. I want to see if I might have skipped over this. What I'm looking for, I'll show you just here in just a second. I can't find it, but what I'm looking for is the dollar amount at loss there. Remember that in the vast majority of cases, we're looking for a dollar amount that is equal to a certain percentage. So let's say, again, if I'm building out this portfolio and I decided, okay, CBAIT, it was a buy signal. Let's say this morning we wanted to buy into this stock, then I would say, how many shares should I buy? If I'm buying it in this portfolio and I want 100, let's say I want 1,000 shares. It's like, wow, that's $24,000. That's 19% of my portfolio. That's way too big, right? We know all I want is 2.5%. So at 100 shares, that's 2%. So if I go 125 shares, that's 2.45%. So 2.45% of my entire balance, which in this case is 121,000, is the amount that I want to put into a trade. That's $3,000. Well, where should I place my stop loss? Well, let's look at a couple of scenarios. I want this number to be 0.3 or lower with a sound stop loss. So let's set our stop loss at 21. You can see that 21.94. Let's just put it at 21 and see what that does. 0.33. Okay, so that's good. That's inside of the range that I'm okay with, around that 0.33 level. That's $300. What that means is if this stock drops from where it's at now to $21 right here, I'm exiting and I'm out that much money. Okay, I'm done. Okay, I'm done playing. I've lost the money. So be it. So what? Right? It's just it's not my teammate. Okay, sometimes I think of these stocks as, you know, as team members or employees, or, you know, a part of a group, you know, workers, your army that's out there doing work for you. And as we're selecting those, we want to be able to select different criteria. One is it's moving in an uptrend. It's strong, in a strong stock. It's got a high rank. So, but sometimes it just doesn't happen. It just doesn't work. And so we want to make sure that we have a dollar amount in mind if and when we are wrong. We will be wrong. Okay. This portfolio is up 20% since September. We've had some really big winners and losers. Had some big winners, I should say. Okay, the profits 147. Had some nice winners. But if I flip the switch here, you can also look at the losers. The biggest one was 18%, and then a whole bunch of 5, 6, 7, 8%. So I shouldn't say a whole bunch, but there are a few, yet we're still making 20% in a relatively short amount of time utilizing this methodology. That's because our winners are so big. Okay, and so we're letting those winners continue to work. Okay, and a good example of this is this stock right here. See where it's at today. It had a big run, 123. So this one's up 123%. Almost all of it was yesterday. Okay, and the buy location on this stock was right here. Okay, so it had broken out. It entered in the new buy alert signals here, the new buy scan, I should say, right here. And now it's just like, hold on to it. Just hold on to it and wait for it to stop working. Now, that being said, we have an exit strategy as well to be able to exit into the winners or exit out of winners that are starting to get too big. And I'm not going to get into that today as well, since we're running short on time, but Thursdays we cover that just a little bit as well. Also on I've got a new strategy. There's a link on the products page. I'll put that in the footer. Well, it's already in the footer of any of the recordings on YouTube, but you can access that. We're managing these every morning together in a Discord channel. And so you can be a part of that group and watch to see which ones we're adding, which ones are we selling. But this is a good example of, I couldn't have chosen this stock. I would not have known what the amazing new technology is that these guys have. Okay, but all of the big heavy hitting institutions on this planet have done that already. All we have to do is jump on board when it's a good time to jump on board, and then catch the ride, catch the bulk of that ride while it's working. We caught a bunch of those a bunch of those crypto miners in that uptrend. Now we're getting medical and biotech. Medical and biotech is going hog wild right now, and you're seeing a lot of that back in muscle stocks. So here's another one, MPC. This is a medical instrument stock moving higher. That one also was added in to the portfolio, right? I think that's a relatively new one right here. Was this bar right here, and that's already up. Let's see. In I don't know why my eyes are not working the way they should. I know we're still in that, but I'll double check on that. I thought we were in that, maybe not. Anyway, that's another example. So it's another example of shifting. Marathon Digital is still in there. We had a big run up on some of these stocks, these crypto miners, but now they're consolidating, and some others are kind of taking their place and starting to work. So we want to be able to participate in that. So just to summarize here, market conditions, again, upper end of that range, watching for any support right here on S&P 500. We could get a continuation breakout. We could also hit some resistance and retrace just a little bit lower on these moves. So that'll do it for today's session. Appreciate everyone's time and effort, and we will see you next time. Thanks a lot. Bye now.